was everybody's weekend? Monday just blew by. How's everybody doing today? Good, good. Very good, good. Yeah, not too bad. Weekend was busy. Had to we had a bit of a personal emergency on Friday, which kind of kept me busy. And then yeah, busy weekend. Mowing the lawn on Saturday after my girl was at the hospital. And some good weather. Air conditioning wasn't working, which was a little unfortunate. I feel like my air conditioning works and then it breaks and then it works and then it breaks and then it works and then it breaks, and they finally came by yesterday, and like my air conditioning's. Good afternoon, Vanessa. My air conditioning is set to 19, which I know is freezing. But the only reason it's set to 19 is because the air conditioning isn't getting my apartment below 22 degrees. So the maintenance staff came by yesterday and they're like, your air conditioning is working just fine. And I was like, no, it's not, because it's set to 19 and it's at 22. And they're like, well, your apartment's never going to get to 19. And I said, well, it has in the past, so I don't know what's different, but it's set to 19 and it's still not getting any lower than 22. And they said it's working just anyway. It was a back and forth with the maintenance people. And then Leafs game last night. Oh my goodness, can't handle the Leafs anymore. Every playoff season, I'm like, I should buy a Leafs jersey. Just represent the team. I don't have a Leafs jersey. Could be cool. Go Habs, right, Paul? And yeah, so it was just not a good night for me. Question? Yes, absolutely, Vanessa. What is your question?
Good afternoon, Professor. Sorry about that. I just wanted to know if we're covering chapters 9 and 10, but we're not covering chapters 7 and 8.
That is a good question. So we've reversed it a bit. Instead of covering the original schedule that we were following the topical was, we were going to cover 7 and 8 today, and then chapters 9 and 10 on Thursday of this week. I've reversed them. I think I had mentioned it in an announcement. We're reversing them, so it's going to help you a bit more with your assignment number 2. Is just going to introduce some important terms earlier, and it's going to give us extra time at the end of the semester, so I can give you the week in the final week of the course to complete your final exam. No problem. Yeah, there's quite a bit of content in the course, and I want to make sure that you're all given enough spare time in the final week to be preparing your final exam. I also know that you have other courses that have final exams in that week. Don't be afraid of the final exam. It's not a test. 44 pages long. I'm going to show you how to navigate those 44 pages pretty quickly. And even what we're learning today, it's going to help you be able, and this is for everybody, it's going to help you be more familiar with some of the things you're going to look at, right, on that 44-page report. Over the next couple of weeks, we're going to be showing you how to analyze that information and kind of boil it down to useful financial information to be used to make a decision. In fact, right now, I can tell you you're the only question on your final exam, and the question of your final exam is, would you invest in Cara or not? So you have to look at their financial report. You're going to have to do different kinds of analysis that we're going to talk about over the course of the next couple of weeks, and you're going to use those analyses as the justification for your decision, right? You can. It doesn't matter whether you want to or whether you don't want to. It matters the justification as to why you've made those decisions. That matters. So don't worry about that too much. Excuse me. We're going to practice lots. And if I'm cutting out, it says right now that my internet signal is not that great. If I'm cutting out, can somebody let me know, just in case? And yeah, so this today we're going to talk about the balance sheet and the income statement. Okay, and then next week we're going to talk about closing entries. And another reason why I've switched the two classes is because I wanted to kind of pump the brakes on the accounting process a bit, just to give everyone some time to breathe, because I know your midterm's open this weekend. Sorry, this week. And to that point, your midterm is open. It opened yesterday. I've seen that some of you have completed it already, and good job. It will stay open till Friday at midnight, and just as a reminder, it has 47 questions on it, and you have 2 hours to complete the final exam. Sorry, the midterm. I apologize. Hey, Ryan. And on that, I think that's all I had to download to you good folks. Does anybody have any questions, comments, concerns before we get going today? No? Okay. And one last comment I'll make before we continue today is that the class worksheets that we've been doing, I kind of reflected a little bit after our last class, and I found that I felt like I had gone maybe a little too fast and left some people behind. And I understand that you're trying to complete the worksheets as I'm doing them and for submission after class. So instead of having the class worksheets due that class day, you can submit them by the end of the week. Okay, just so you know what I mean. If you've I just want to make sure that you're more focused on watching me and practicing with me than trying to kind of copy exactly what I'm doing down on your worksheet. Okay, so the worksheets due by the end of the week for participation grades. Okay, and again, I record all the lectures, so if there was something that maybe you were unfamiliar with, or you're completing the worksheet and you're like, oh, I'm not quite sure what to do with this, you can always go back and watch the class video where I complete the worksheet. Okay, so that should help. Do you think that'll alleviate some stress in trying to follow along? What do you think? Any other recommendations? What do you think? Okay, yeah, absolutely. It's a good idea too. Okay. All right. Well, let us continue. So the income statement and the balance sheet. First, we're going to talk about the balance sheet. Paul, just wondering when we're going to get our marks back for our trial balance. You mean assignment number 1, Paul? Yeah. It was submitted. The due date was when? Sunday. So you got to give me you got to give me a week to get those back. Okay. The worksheet that you're using for your second assignment, it's already posted, so you don't necessarily need to use the first worksheet. You will use assignment number 2's worksheet to complete assignment number 2. JAWS. So today we're going to tell you, we're going to be talking about, at first, we're going to be talking about the balance sheet. Okay. We're going to show you and define the different kinds of balance sheet formats that you are going to could possibly be exposed to. We're going to show you what a classified balance sheet is, essentially how to make it. Then we're going to talk about various kinds of assets and then define those. We're going to talk about various kinds of liabilities and define those, and then we're going to talk about different kinds of shareholder equity accounts that would show up on your balance sheet. Okay, we were going to, and then we'll talk a little bit about statement of retained earnings and how to kind of produce one. Okay, so today is a bit more relaxed in that we're going to be defining things and showing illustrations and then trying to create them for the first portion of the class. During the second portion of the class, I will have different learning objectives, and those are much more oriented towards the income statement. All right, so the balance sheet. It's one of three basic financial statements. Okay, and remember that financial statements are kind of the end product of the accounting cycle. The balance sheet is fairly, I find it is under leveraged by many professionals. And the balance sheet reports the financial health or the financial status of a company at a given point in time. While the income statement shows performance over a period of time, the balance sheet shows financial health or status at a single point in time. Your balance sheets include the ending balances of your assets, your liabilities, and your shareholders' equity accounts. And we take that from the financial worksheet that we've been working on. A classified balance sheet, which we'll talk about a bit more later on, is a type of balance sheet that provides specific information to users of accounting information about the firm or the business's financial health. Okay, so it's a bit more specific because it's classified. When we're looking at balance sheets, the most typical kind of balance sheet that you will look at or see is a classified balance sheet. So that's why we're going to be talking about and looking at them today. What else would I mention here? Can anyone remind us what the equation is that provides the foundation for the creation of a balance sheet? I'll start it off here. Your assets must equal what? Or the value of your assets must equal what? Absolutely, Vanessa. Your liabilities and equity or owner's equity. Absolutely. Now, just like your trial balance must balance, your balance sheet must also balance. Okay, and it must balance in that your assets, the total value of your assets on your balance sheet, must equal the total balance of your liabilities and your shareholders' equity. I think, what else would I mention here? I've had conversations with other professors across divisions within the college, all coming from an accounting or a business perspective, and they always find that they always say that they want to teach entrepreneurship students or management students more about the income statement than the balance sheet. And I'm really critical of that, because the balance sheet, it contains so much useful information, specifically to external users of accounting information, that has an impact in a lot of decisions that they would make. And I hope to show that today, but even more so at the end of the term. Yeah, so I hope that becomes a little bit more relevant as we progress. So we have different kinds of formats that balance sheets can be created in. Excuse me. First, we have the account format, where two parts are presented side by side. Okay, so that's your assets are shown on the left side, and your liabilities and your owner's equity are shown on the other. So it's kind of horizontal, if you will. Then we have the report format, where the two sides, so your assets and on the other side your liabilities and your owner's equity, are presented one under each other. Okay, so this is more so vertical, if you will. This is also known as a vertical balance sheet. And then inside either of those formats, balance sheets can be created in a way that is classified. So we classify different accounts into different categories. Okay. So before we continue here, I'm just going to do a little bit of an illustration. Okay. So your report format Okay, so the report format of your balance sheet is one where you list your assets. On the left-hand side, so imagine this is your balance sheet here. So I'm going to try and make this look kind of like a balance sheet. There we go. And then you have all of your assets, and your total assets are listed at the bottom. There we go. Then there's a little bit of a division, okay? And then on the right-hand side, you have your liabilities. They are listed. And then you have a total for your total liabilities. I'm just going to put liabs there. And then you list your shareholders' equity, or your equity. Okay, and you list. And at the bottom, you have your total liabilities. I'm just going to put lives there. And shareholders' equity. So I'm just going to put equity. Okay. So again, the report format shows your assets and your liabilities side by side, or your assets and your liabilities and your equity side by side. So it's much more horizontal. Okay. And sorry, this is the report format. This is the account format. I apologize. There we go. This is the account format, and at the very bottom, your total assets must equal your total your total assets must equal your total liabilities and total equity. I'm confused with the liabilities and the equity. Confused about which? The definition around them or the formatting here?
So I'm just confused, sorry, Professor, because I see liability and then it goes down to total liability, shareholders equity, and then it continues down to total liabilities and equity. Is that the same thing as the previous one?
No, so it's that's a good question. So your total liabilities and equity is the addition of your total liabilities and your total equity. So imagine there's a total equity here. Here we go. So you take your total liabilities, you add your total equity, and it gives you your total liabilities and equity. So it's just the combined value of those two totals. And then that total, so your total liabilities and equity, must equal your total assets. Does that help, Vanessa?
Hi, David, this is Catherine. So just wondering, how does that change then? Like, what is the difference from the start?
How do you mean?
Let me clarify.
The start from where?
So for the total liabilities and the shareholders' equity,
yeah,
at the top, and then at the bottom you have it total.
Yes. Okay, so sorry, just cut out a little bit.
Sorry, are you supposed to add everything together?
Correct, yes. So maybe I can.
Thank you.
No problem. It's all good. No problem. I'm just going to erase this quick. There we go. So just to kind of expand on that, so you have your total liabilities, which is the sum of all your liability accounts. Let's say in this case, your total liabilities are $100. Okay, it's not very realistic, but we're going to run with it. And then on your balance sheet, your total equity or shareholders' equity is another $100. In this case, your total liabilities and equity would be equal to 200. It's your total liabilities and equity is just the sum of your total liabilities and your total equity. It may seem a little redundant to take a total of the two totals, but the reason we do this is because your balance sheet must balance in that your assets must equal your liabilities plus your equity. So on this particular balance sheet, if we were to look at the total for your total assets would also equal 200 because your assets must equal your liability and your equity. All right, so I'm just going to pull up that PowerPoint again. There we go, share. Oh, no problem at all. So that was the account format of how we can present a balance sheet. Okay, the report format is where the two sides, so your assets, and then on the other sides your liabilities and your equity, they're presented one under each other, and it's a lot more vertical, if you will. So I'm going to share my whiteboard again, just to give you an idea to a visual how it might look like. Whiteboard, there we go. So at the very top, and this is a report style, report format. You would have your assets category, and then you would list all your assets. You would provide a total for all your assets, and then you would list your liabilities, and then provide a total for your liabilities. There we go. And then you would list your equity accounts or shareholders' equity, provide a total. There we go. And then last step is show your total liabilities and equity. And because this is a balance sheet, your total assets must equal your total liabilities and shareholders' equity. So both of these formats, the account format and the report format, they contain the exact same information. They're just showing it in a different way. Okay, it's largely the difference between listing your accounts, your balance sheet accounts vertically versus horizontally in the account format. So I'm going to come to the chat here. Very welcome, Vanessa. So I'm going to put up file again here. Does anybody have any questions about any differences between those two accounts? Okay, And just before we continue, both of those formats, the account format and the report format, they're typically drafted into what we call a classified balance sheet. And a classified balance sheet is where we categorize accounts into different subcategories to give the reader of the balance sheet more specific information about particular accounts. Okay, we have inside of the asset category, we have two different kinds of subcategories. Inside the liability category, we have two subcategories, and then in the equity, the shareholders equity category, we have we really only have one category, but there's different kinds of accounts that we haven't been quite exposed to just yet. So on the classified balance sheet, and you know what? I'm actually going to put up an illustration first. Just let me find it here. There we go. Okay, here we go. So we just skipped ahead a lot. We're going to go back, but I just wanted to give you a visual of what a classified balance sheet looks like. Okay. Here, this is a balance sheet for example company. Okay. On the you'll also note that this is an account style balance sheet because your two categories are listed to the left and to the right of each other, opposed to above and below. On the left-hand side, we have listed all of our assets, and we have categorized those assets into different categories. For example, current assets is a subcategory. Oops, sorry, I don't know why it does that. Your current assets is a subcategory of asset accounts. And then we have, in this case, we have property and equipment. I don't know why it keeps doing that on the screen. There we go. We have plants, property, and equipment. And then in some cases, we'll also have intangible assets. Okay, we can also have other assets. These categories give us information about what to expect from those accounts. For example, current assets are assets that are liquid or are the most liquid for a company. Liquidity refers to our ability to turn those asset accounts into cash within one operating year. Okay, so things that can be turned into cash very quickly are considered to be liquid, and they are current assets because they're our most liquid assets, right? Every other account on your balance sheet can then be classified into one of those three categories, or more generally, non-current assets. Non-current assets are those assets that the company owns that cannot be liquidated within one operating year. So, for example, here, your land, or sorry, your equipment, or your building cannot be liquidated within one operating year for a business. On the other hand, within your current assets, which can be liquidated very quickly, you have cash. Cash is always your most liquid asset, liquid current asset, because cash is cash. You don't have to turn money into money, right? So some different categories, and again, we'll go over more definitions about what those are in just a second. And then on the right-hand side of our balance sheet here, we have our current liabilities, which in a similar fashion are those liabilities or financial obligations that are due within one operating year. So we have to pay our current liabilities within 1 year. On the other hand, our non-current liabilities or long-term liabilities, right here, are those financial obligations that are not due within one operating year. So accounts payable and accounts receivable would be considered, but notes payable isn't. Accounts payable is a current liability, yes, because we have to pay our accounts payable within one operating year. And then accounts receivable, which is right here, is a current asset because it is payable. Because it's assumed that we can turn those receivables into cash within one operating year. Exactly. Yeah. The difference is kind of short and long term, but it's also a matter of what is short and long term. For your assets, can it be turned into cash in the short or long term? And then when your liabilities is the difference is whether or not you have to pay that obligation or that financial obligation within the short or long term. So absolutely. And then down here we have our shareholders' equity. There's no specific subcategories within our stockholder or shareholders' equity, but there are going to be some interesting new accounts that we haven't spoken about just yet. For example, Treasury Stock, right? And then at the bottom here, you'll notice you have your total assets, and you have your total liabilities and shareholders' equity, and they balance, right? And it could, you can tell a lot about, or more specific, you can get more specific financial information from the balance sheet, the classified balance sheet, because if it wasn't created like this, you wouldn't know exactly how much money is due within 1 year, or how liquid or how much cash the company could have within 1 year. So it does tell you a little bit more about what financial obligations the company has to pay within the short term, and whether or not they have the cash to do that. For example, your current liabilities are $61,000. Your total current liabilities are $61,000, and your total current assets are $89,000. So looking at that, which one is higher? Which one is a higher value? Your total your total current assets or your total current liabilities? Take a look. Which one's higher? Yeah, your assets. Now, this is typically what you want to see, and this is a good thing, because what this means is that we have $61,000 worth of costs we have to pay within one operating year, and we have at the very worst case scenario, we have $89,000 worth of potential money that we could pay that with. So in this case, that looks good to a potential investor because, hey, you have $61,000 worth of financial obligations due within the short term. If anything were to happen with the business, I know that they could pay that because their most liquid assets exceed the value of those financial obligations. So it's a good thing, right? Also, when you break, I'm just going to kind of erase what's on the screen here. Also, when you break down your liabilities into the two different categories, so your current liabilities and your long-term liabilities, you can see what kind of long-term debt the company has and compare that to the total shareholders' equity, right? If we go back a couple classes, the company's assets are things that are of value to the company, right? They help us produce sales. They're tangible, they have value, things like that. Another definition around your liabilities is creditors' claim to those assets. Stockholder or shareholders' equity is the owners or the corporation's claim to those assets. So here, our long-term liabilities, which is essentially our creditors, like the bank, we have $420,000 worth of long-term liabilities. If we look down here, we only have $289,000 total shareholders' equity. So that means our creditors have more of a claim to company assets than the company does itself, right? This isn't necessarily a bad thing. All companies have some degree of debt, even quite high debt, but and we'll show in the coming weeks, there is a certain of debt to equity that could be concerning to us if we were going to invest in the business, right? We want to make sure that the debt of the business, the long-term debt, is at a reasonable level where our equity, if we were to invest, we're actually going to get value for that investment. So a couple of different ways you can use the classified balance sheet. But now we're going to go into more of a definition around those subcategories and the accounts within those categories. Before I continue, does anybody have any questions about the classified balance sheet now? Yes, Vanessa, absolutely. So we would want our liabilities to be lower than our assets. Yes, we would want to, and they're always going to be. How much lower than your total assets? Be a matter of conversation in the coming weeks. Absolutely. Okay. So I'm just going to go back a couple of slides. I say back a lot. I was comparing total liabilities to total equity. Oh. There we go. So again, yeah, Vanessa, I was comparing the total liabilities with total equity in the last little discussion there. So yeah, the classified balance sheet has us classify our assets, our liability, and equity accounts into different subcategories, right? Within our assets, as you saw, we have current assets, which are those asset accounts that we believe can be turned into cash within the short term or within one operating year. The listing of those assets within your current asset category is listed in terms of liquidity. So the most liquid assets are listed first. And then as it becomes harder to turn it into cash, it becomes listed later. That's why cash is always listed first, because cash is your most liquid asset. And then after that, you have your non-current assets. Okay, some classified balance sheets just call the rest of these accounts, categorize them as non-current assets, but they can also be classified into different categories, such as property and equipment, which would list all of your property and equipment accounts, and then other assets. So assets that may be intangible or they're primarily intangible assets. So those assets that are of value, but they have no physical mass, right? So this could be patents, trademarks, goodwill, things like that. Within our liabilities category, we have two subcategories. We have our current and long-term liabilities, and to Vanessa's prior point, the difference between these two categories is a matter of short or long-term financial obligations. So current liabilities are those that are due within one operating year, and long-term liabilities are financial obligations that exist outside of one operating year. In some cases, there are other liabilities, but it's very rare that you would see those. So I can't really see. I wonder why all these got super small. I can kind of see what they are, so I can write these in. So the first category within your assets is your current assets, or your most liquid assets. And inside this category, you'll find cash and other items that can be converted into cash or consumed within one operating year. And some examples include, I'm gonna use the text here. One example would be cash. Okay. Which is just the value of all the cash we have on hand. Accounts receivable. Okay, which is the amount of money that our some of our customers owe us. You could have marketable securities. Which is the value of any investments that your business has in another. So it's like owning shares of another company. We call those marketable securities. What would be another example? So your food inventory would be an example of a liquid asset, because we try to turn that into cash as much as humanly possible. Your prepaid expenses would be considered a current asset, because as time progresses within that operating year, we start to use those prepayments. Maybe your beverage inventory. All are examples of liquid assets or current assets, because all of these accounts can be turned into cash or turned back into cash within one operating year. Does anybody have any questions about current assets? Is that fairly clear? All right. Put a thumbs up in the chat if you're ready to continue. Got some thumbs. There we go. Right. There we go. And this is what the current assets section of a classified balance sheet would look like. At the top of the balance sheet, you've got the name of the company. You've got a title for the what is it called? For the statement itself, the date, of course, and in some cases a reference to how some of the numbers are being shown. For example, you can show in regular dollars, or sorry, in dollars, or in thousands of dollars. So it's you take the true value of the account and divide it by 1,000. Okay. In this case, it's in thousands of dollars. We're not going to worry about that too much. We're just going to focus on the numbers here. So we have, first we list the category. So this is our asset category. And the subcategory here is our current assets. And then we list all of our current assets. All right, so we've got our cash, marketable securities in this case. And then we have our accounts receivable with an allowance of doubtful accounts, so bad debts expense from last week. We have our inventories, and then the value of our prepaid expenses. We add all of these numbers up, so we add it, to get the value of our total current assets. And that is the first section of our balance sheet. And then the next section of the balance sheet is our plant and equipment, or property and equipment, I should say. And this is a section that you can have where it lists all of your property and equipment. So in this case, we have the value of our land that we own, the buildings that we own, any furniture, fixtures, and equipment that we own for total. We then would subtract the accumulated depreciation. And then we would have our net property and equipment. So within this category, we've just listed all of the accounts that fit within the category. So they are either representative of being property or equipment that's owned by the business. And just like the other sections, we add up all of the account totals to get our net property and equipment, or total property and equipment. So other assets. So these assets or other assets are those accounts that have a future value but are not necessarily used in operations, right? So it's not any kind of plant, property, and equipment, and they're not current assets, so they can be turned into cash very quickly, right? Some examples are intangible assets. Okay, so goodwill, trademarks, patents, things like that. Long-term investments, so investments, large long-term investments into other businesses. Long-term receivables, so when a customer owes you a certain amount of money and you have an agreement with them to not receive that for a certain period, for a long period of time. And then in some cases, the cash surrender value of an officer's life insurance. Some executives in the business world are insured by life insurance, and they have I forget how to, what this is called. They have a deductible that they can draw on, so they're allowed to get some of that life insurance back based on a certain premium. I forget. It's not very often that this happens, but it's usually done for like CEOs of corporations, right? A lot of businesses take a lot of steps to protect their CEOs and their top management. Has anyone seen the TD buildings in Toronto or downtown Toronto? I forget what street they're on. Have you ever seen those, the TD buildings? Yeah, on Front Street, absolutely. So big, massive buildings. Where do you think the top, in what floor, okay, where do you think the top management, the top executives' offices are? Are they at the top, are they in the middle, or are they at the bottom of those buildings? What do you think? Top, middle, bottom? Top corner? Top? Yeah, I would agree. That would have been my first thought. Yeah, the top would probably where you would put, or seems where you would put an executive. Absolutely. No, it's actually near the bottom. The reason they do that is after after 9/11, they started moving their top executives to below the top floor. In the event of an emergency, they get out of the building first. It's kind of cruel, but it's true. Interesting story I've heard from a TD employee. Again, we can't see these. Why? Who goes on the top floor? I don't know. I never asked that question. That would have been a good question to ask. Never asked that. So now we're moving on to the liabilities sections and categories within the classified balance sheet. The first is our current liabilities, and these are those accounts that are, or financial obligations that are due within one operating year. Some examples are your accounts payable. So the amount of money we owe to our suppliers. Our wages payable. So the amount of money that we owe our staff. Interest payable. So the interest on any long-term loans that we have to pay in the short term. Taxes payable. So the amount of taxes that we owe to the government, right? And these are all characterized because they're essentially costs that we have to pay that we haven't paid just yet that are due within one operating year of the balance sheet date. There we go. And this is what the current liabilities section on the classified balance sheet would look like. We've got the category. Oops. We've got the category. A current portion of long-term debt. So that's almost like interest, if you will, or interest plus principal. We have our accounts payable, of course. We have our income taxes payable, and various accrued expenses. So within that account, it could be things like your wages, utilities payable, things like that. And then, just like other sections, we add all of those balances up, and we get our total current liabilities. Long-term liabilities, on the other hand, are due after 1 year from the balance sheet date. So they're more long-term, right? Some examples here would be bank loans. Okay, so bank loans are typically due in the long term. Okay, some mortgages are due in the long term, and these are example of accounts that would be long-term liabilities. Is it possible for more than 1 year? Absolutely, and that's the rule. That's the rule. Our long-term liabilities are long-term because they are financial obligations that we have outside of 1 year. So our bank loan could be due in 15 years. Our mortgage could be due in 25. The difference doesn't matter as long as they're due more than 1 year in the future, which characterizes them as long-term. Absolutely. And then we have our shareholders' equity, which again is the amount of money that investors have paid into the corporation or the amount of money the owner has in the business. Yes, exactly. And then short-term is under 1 year, or current liabilities are under 1 year. Correct. So we have different kinds of shareholder equity accounts that we might not have been shown just yet. So accounts payable is under 1 year. Absolutely correct. Yes. Typically, we try and pay our payables within 30 days. We have two different kinds of stock that we can have within a corporation. First is the common stock, right? And that's these are common stock is stock that's typically available on the stock market. Okay, if the corporation is publicly traded. Preferred stock, on the other hand, is stock that it differs in a couple of ways. One, preferred stock is paid out before common stock is, because they get paid out dividends, and dividends is kind of the profit of the corporation that's paid out to shareholders. Both of these people, preferred stock and common stock, these are shareholders of the company, but preferred stock gets paid out first because they're a priority investor. Otherwise, common stock is everyone gets paid at the same time from profit, whereas preferred stock gets paid from operating income, and it's treated kind of like an expense. We don't have to be too familiar with that just now. That'll become more relevant in finance in a couple of years. Sorry, not in a couple of years, next semester. Not next semester, the fall. So just kind of introducing those terms now, just kind of get it on your mind. Our retained earnings, I think we've spoken about before, is just that cumulative profit that has happened over the course of the business's life, right? And we'll be talking about retained earnings a bit next class, because that's one of the closing entries we have to do. And then lastly, our treasury stock, which is a new account that we haven't been exposed to yet. Our treasury stock is the amount of shares, or the value of the shares that the company has repurchased from shareholders. Weird, right? Typically, we understand shares, or the purchase of shares, as being purchased by investors and purchasing them from a company. The company can also purchase stock back. Does anybody have any questions about any of these 4 account types that would show up in our shareholders' equity? have to excuse me, I'm just going to blow my nose. The only other thing I'd say here is your common stockholders have voting rights. Oop. And your preferred stockholders have no voting rights. Has anyone heard of something called a shareholders annual meeting? Nathan, okay, yeah. So a shareholders shareholder annual meeting or yearly meeting is where all shareholders of a company come together or can come together to vote or cast a vote on certain issues. So that's a board, that's certain directions that the company wants to go in, and only common stockholders have voting rights. So preferred stockholders, while they are shareholders of a corporation, they cannot vote at the annual shareholders meeting. Absolutely. All right, let's just continue here. Oh, okay, well, that's where I've put all of the definitions around common stock and preferred stock. We've covered most of that. Also kind of talked about retained earnings. Yeah, absolutely, Vanessa. Common stockholders are people that have invested in the business and have the right to kind of dictate what happens in the future. The more shares you have, the more shares you have, the more sway or the more voting power you have in controlling that direction. For example, I own shares in a bunch of different small companies, but the value of those shares are so small, I'm never going to go to those shareholder meetings, probably because they're all in the States, but also because my vote would be a drop in a pond, and drop in the sea, and it wouldn't matter. Absolutely. We've kind of also talked about this as well. Our retained earnings is that accumulated net income that has not been distributed in terms in the form of dividends to shareholders. And in some cases, we produce a statement or a financial statement called the Statement of Retained Earnings, which shows changes from one year to another in our retained earnings account. And typically the difference between the years is the new profit that's been attained by the company, less any dividends or withdrawals that have been taken out of the equity. I believe I've got a visual on the next slide here. No. Also talked about treasury stock. There we go. So here's the illustration, right? And here we have our shareholders' equity category. We list the value of all of our common stock. We list all of the value of any additional paid-in capital, so the owners putting more company money into the business. Your retained earnings, and then you subtract any treasury stock, because this is the amount of money or the amount of shares that the company has purchased back from shareholders. So we do the math here. You add the first three. You then subtract the treasury stock, and you get your total shareholders' equity. It's a good question, Vanessa. Absolutely. So when any number is in a bracket, so in this case, our treasury stock, to Vanessa's comment, that means we subtract it. Absolutely. All right. And here again is that illustration. No problem at all. Where we've shown all of our assets. Awesome. And we've got the total value of our assets here, so $770,000. And then we've listed all of our liabilities. That. We've listed all of our shareholders' equity. And then we got them together to get our total liabilities and shareholders' equity. And in this case, they balance. This balance sheet has been created correctly because they balance. All right, so now it's pretty much 2 o'clock now. What do you say we take a quick 15-minute break? What do you think? All right, I'm figuring everybody else agrees. So we'll take a quick break. It's 2 o'clock. Let's be back at 2:15. All right, grab a snack, a beverage, and we'll see you in 15. Have a good break, everybody. All right, welcome back, everybody. Everyone had a chance to maybe go grab a snack, grab a glass of water, coffee, even. So I got a question up on the board here. The question is, cash, accounts receivable, and inventories are considered to be which of the following? Okay, so the first selection is current liabilities. Second is shareholders' equity. Third is current assets, and the fourth is non-current assets. So what do you think? How do you think you would categorize those three accounts? Cash, accounts receivable, and inventories. What do you think? And if you're having trouble thinking about it, ask yourself if these are of value to a company, maybe how liquid they are, or how quickly they can be turned into cash, whether or not they're a financial obligation, and then maybe whether or not these represent the owner's equity in the company. So get some more responses to go. Again, cash, accounts receivable, and inventories. Are they of value? Can they be turned into cash quickly? Or within 1 year, I should say? What do you think? I'll give you another minute here. Answer the question. All right. So yes, the majority of you, the vast majority of you answered correctly. Cash, accounts receivable, and inventories are considered to be current assets because they are of value to the company and they can be turned into cash within 1 year. So they're considered to be liquid assets. Okay. So I'm going to stop showing that and I'm going to put up another question. Polling, multiple choice. So, for everybody, I'm just typing in the question here. Another question here. Start. A bank loan and mortgage are considered to be which of the following? Non-current assets, current liabilities, shareholders' equity, and non-current liabilities. And when you're thinking about this question, ask yourself, are bank loans and mortgages financial obligations? Okay. And maybe whether or not they're due in the short or long term, or whether they're due in the short or long term. Also consider most bank loans and mortgages are payable or due within like 10 years or so, 5 to 10 years. I'll give you another quick, maybe 30 seconds here. Okay. Kind of divided here. The answer here was non-current liabilities. Bank loans and mortgages are not due within one operating year, and they're a financial obligation. So it's non-current because they're due outside of one operating year, and they're liabilities because they're financial obligation to pay. Okay, they're not current liabilities because they're not due within one operating year, and yeah, that was the only two responses that I saw. So they're not current liabilities because they're due outside of one operating year. So I'm just going to put up another one here. Good. I try to use them, but you can't pre-program these polls in advance, which is kind of not the greatest. So I'm going to put it up another one here. Maybe do a yes and no, or a true and false. Here's a yes and no, or a true and false question. So common stock is found in the shareholders' equity portion of the balance sheet. What do you think? Yes or no? All right. The yeses have it. So this is correct. Common stock is an equity account, and it is found, as a result of that, it is found on the shareholders' equity portion of the balance sheet. All right, we'll do maybe, excuse me, I had a spicy chicken finger on the break. Stinging my throat. So one more question before we continue here. Here we go. Okay, last question. So accounts payable, wages payable, and interest payable are considered to be which of the following? Current assets, current liabilities, shareholders' equity, or non-current liabilities? Okay, we'll give you another 30 seconds here. All right. Most have got correct, which is great. Accounts payable, wages payable, and interest payable are considered to be current liabilities. The reason these are current liabilities is because these are liabilities, they're financial obligations to pay, and all of these are examples of financial obligations that we need to pay within the short term or within one operating year. So would be current liabilities. Good job, everybody. There we go. So now what we're going to do is I'm going to bring up a worksheet, and I'm going to actually go and create a balance sheet from some of the financial information that we have on what is it called on the worksheet. So this worksheet that I'm going to be working on is in our weekly learning materials, posted to this week's materials. I'm just trying to find out the name of it exactly. It is called the Balance Sheet and Income Statement Worksheet on Blackboard. Okay, and so I'm going to show you how I would complete it. I'm going to go by section by section, and then I'll come back to the chat to see if you have any questions. And yeah, please try not follow along with me. So watch what I'm doing. Kind of appreciate the process. You don't need to fill out this worksheet right now as I'm doing it, okay? Because I want you to watch it. And again, the worksheet for participation isn't due until the end of the week, okay? So follow along with me, watch the process, watch the logic, and then you can do it yourself later. If you're still having troubles with it, you can watch the video because I'm recording. Does that sound good, everybody? Put a thumbs up in the chat if you're ready to, if you're good for me to start working on the worksheet. All right. So I'm going to share my screen. There we go. So here's that worksheet that I'm talking about, right? And then down here on the balance sheet tab, that's what I'm going to start working on right now. You should have on your worksheet all of these listed out, all of the categories, okay? And I'm going to, those categories are there for as a structure for you, all right? And what I'm going to be using as the input to this balance sheet is the account balances, found on the financial worksheet. So here's the financial worksheet. You'll notice that it is already completed, so we can start to plug in these information into our balance sheet in our income statement. But we're going to do the balance sheet first. So I'm going to go down and go account by account and classify each account, starting with my current assets and assets for that matter. And then I'm going to transfer that information to the balance sheet worksheet. Okay, so here I'm going to start working on my assets first in my current asset category, because that's the first category within the balance sheet. And here I've got my cash account with $96,560. Okay, cash is a current asset because it is cash. So I'm just going to copy. I'm going to copy the balance. There we go. Come to my balance sheet, and then under my current assets category, I'm going to type in cash, and then I'm just going to paste the value. But it won't let me. It was letting me before. Well, I'm going to have to go back and do this manually, or do it this way. There we go. So $96,560. So I'm going to go back to my worksheet, and I'm going to keep going down, and my next account here is food inventory. Okay, my food inventory is a current asset because it is an asset, and I can turn my food inventory into cash within one operating year. So I'm going to plug it into my balance sheet. So I'm going to put in food inventory, just like that. And then I'm going to transfer the balance over, or copy it over. There we go. Just like that. So now I'm going to go back to my financial worksheet here. My next account that I have is liquor inventory or beverage inventory, right? So is this a current asset? I would say so. Just like food inventory, it is an asset. And we hope to turn that into cash within one operating year. So I'm going to go back to my balance sheet. I'm going to type in liquor inventory. Oh, and I believe it was $700. So, and that's all the current assets we have based on the template that I have for you. But just to make sure here, furniture, can't turn that into money very quickly. Equipment, can't turn that into money very quickly. And that's the only, we have cumulative depreciation. That's a non-current asset thing. So I think we've captured, and then bank loan and wages payable. Looks like we've got all of our current assets included here. So I'm just going to total up all of my current assets. There we go, to get the value of my total current assets. So now we've done that. Really good. Now we're going to move on to the non-current asset category, which are assets that are, so things of value to the corporation that help us produce, revenues and things like that in the future. But we cannot turn these into cash within the short term because they're non-current assets. So I'm going to go to find my financial worksheet here and start looking for some non-current assets. And we already talked about some of them here. We have our furniture and our equipment. Both are things of value that the company owns, and they help us produce revenues. But we can't turn these into cash very quickly. So I'm going to start with my furniture. Go. My furniture. Not good at spelling today, but that's okay. This is accounting. And the balance was 10 grand. There we go. And we've transferred that over. Okay. Go back to my financial worksheet. And then next would be my equipment account. Is it a non-current asset? I would say so. It is a value to the business, but we can't turn it into cash very quickly. So I'm going to go back to my balance sheet, type in equipment. There we go. And I'm going to put in the balance. 3,500. There we go. Back to the financial worksheet. Look for more non-current assets. Common stock, that's not a non-current asset. Retained earnings, it's not a non-current asset. What is this? Interest payable, it's a liability. Cumulative depreciation. Sounds to be a couple questions, so I'm going to stop sharing and come see the chat. Question. Okay. Ryan, did you have a question? Okay, Ryan, yeah, absolutely. I'll check it out. So let's go back and share my screen again. There we go. 96,560. 96,560. No, they're the same. Good eye, though. It's always good to double check. So going back to the financial worksheet, accumulated depreciation. It is a non-current asset because it's depreciating our non-current assets. So we're going to put that in, but we're going to put it in as a negative value. Okay. So go to our balance sheet. Here, accumulated depreciation. There we go. And it is going to be negative $350. There we go. So now we can calculate our total non-current assets by adding them all up. There we go, 13,150. So now we've just completed the assets category on our balance sheet. So I'm going to add up my total current assets and my total non-current assets to get the value of my total assets. And in this case, I have a total asset value of $112,410. Okay. So I'm going to stop sharing my screen and see if you have any questions before I continue on down our balance sheet. All right, so what questions do we have?
In Excel, is there a way to, because I noticed that you were kind of doing the VLOOKUP for the cells. Is it possible to make sure that whenever we're doing that, it goes automatically to a negative number?
So you want to format a cell so it's always a negative number?
No, so like for the accumulated depreciation, if I were to say like equals, go over to my financial worksheet and select that cell, but because it's a negative number, is there a way to make sure that when you do that, it comes up as a negative number so that the formula in the top bar stays the same?
I'm not sure, because in the financial worksheet, it's going to show up as a positive.
Right.
And in the balance sheet, we have to represent it as a negative.
Okay.
So
Yeah,
I'm not.
That's the only thing I was wondering. Oh, okay, I actually figured it out. So if you just put a minus in front of if you put equals minus and then select it, it'll transfer it into a negative number.
Oh, okay, I understand what you're saying now.
Yeah.
Oh, awesome.
Okay, cool. Thank you.
All right, so what does everybody else think? Good, difficult, not difficult? Thumbs up or a thumbs down in the chat? What do you think? Okay, some thumbs up. This is good. What does everybody else think? Just thumbs up, makes sense. At this point, when you're creating the financial statements, you've already done all the hard work, really. You've already gone through the accounting process, or the accounting cycle, with the exception of closing entries, of course, but that's next to class. And you're just transferring information that you already have, right? So it's a matter of worrying less about debits and credits and all that lovely stuff. It's more about, is this account going in the right category? Okay, and based on the quizzes that we did before, it looks like you have a good handle on that. So I'm going to share my screen again and continue with the liabilities and the shareholders' equity. Here we go. So now we've got the liabilities category, and we're going to be looking or posting the balances of our current liabilities. And our current liabilities, as a reminder, are those liability accounts or financial obligations that we have to pay within 1 year. Okay, so it's costs that we've had but haven't paid yet that we have to pay within 1 year. So I'm going to go back to the financial worksheet. There we go. Looks like we've completed up till there, and all liabilities have credit balances. So I'm going to look at my credit column. Common stock, no, that's an equity account. Retained earnings, that's an equity account. Okay. Our interest payable. Okay, so the interest on our loans that sounds like a current liability to me, because that's the interest on our bank loan that we pay pretty much monthly, if you will. So it's our interest payable, and it's worth $83. So I'm going to go to our balance sheet, go to interest payable. There we go. And it was $83. Perfect. So now I'm going to go search for the last current liability, right? And food sales, that's income statement. Accumulated depreciation, we've done that already. Wages payable. Yeah, we pay our wages every 2 weeks, or for the most part every 2 weeks. So that would be considered a current liability. So wages payable for $1,000. Or what is wages payable for $1,000? Payable, there we go. And it was $1,000. So we pretty much just went through and categorized all of them. And I think that's all the current liabilities we have. So I'm just going to add up the totals. Go. So we have total current liabilities of $1,083. So there we go, done and done. Let's go to our long-term liabilities, or our non-current liabilities. And let's go back to our worksheet and find where they are. So our common stock, again, that's equity. Retained earnings, that's equity. Interest payable, that would be a non-current, or sorry, that would be a current. Accumulated depreciation, that was a asset. Done the wages payable, and bank loan. There we go. That's a non-current liability because we don't have to pay that back within one operating year. And our bank loan had a balance of $10,000. So I'm going to go back to my balance sheet. Bank loan, there we go. And it had a balance of $10,000. Is that $10,000? It is. That appears to be all the liabilities or non-current liabilities that we have. So I'm just going to put that in as the total. 1, 2, 3. And now I can calculate our total liabilities by taking my total current liabilities and adding my total long-term liabilities. So I do that. I get $11,083. So we've just checked off our liability section. Great. And now we come down to the final section, which is our shareholders' equity. There was only a few shareholders' equity accounts. I'm going to go to my financial worksheet here. We denote that my common stock, my retained earnings, were my only equity accounts here. So my common stock was 100 grand. I'm going to go to my balance sheet. Common stock. That was $100,000. There we go. Done and done. And then the final one was my retained earnings, which was $1,327. So I'm going to go to my balance sheet, put in my retained earnings. There we go. And I'm just going to put in the balance. There we go. And then I can take a balance for the section. So my total shareholders' equity is $101,327. So at this point, we need to calculate our total liabilities and shareholders' equity. And how that's going to work is I take my total liabilities and I add my total shareholders' equity. And I get $112,410. You'll notice here that my total assets are the same value. This means that I've created my balance sheet correctly because my assets equal my total assets and shareholders' equity, which is the one of the basic accounting equations. Right? So I'm going to stop sharing my screen and see if you have any questions. At the bottom of the worksheet through 27. Yeah, absolutely. And that's how you make a balance sheet. And it balanced. This is a good thing. There are times when I make balance sheets and sometimes they don't balance because I make a mistake. Everybody can make mistakes. So what do you think? Any questions? Comments, concerns? Fun to watch? That's good. It's the process. Very satisfying. All right. So I'm going to share PowerPoint again, and we're going to move on to the income statement. Where is the income statement? There we go. Can I explain liabilities one more time? Ryan, what about liabilities? The difference between current and non-current liabilities? Mary Ellen, I learned balance sheets in high school, and doing the journaling first makes it much easier to understand. Absolutely, I agree. I found that the worksheet that you have, I mean, you can use that for the accounting of a small to medium-sized business, right? You don't necessarily need to go out and buy the QuickBooks and stuff, although QuickBooks is just that. It's quick, very quick. But yeah, through the worksheet and the journaling, you can kind of see the process a little bit more. Absolutely. Vanessa, able to follow and understand the process of what seems to be complicated. Very good. Glad as well. Ryan, yes, the difference between current and non-current. The difference between current liabilities and non-current liabilities, at first, they're both liabilities, so they are financial obligations. Current liabilities are financial obligations that need to be paid within one operating year or within the short term. Non-current liabilities are those liabilities that we have to pay in the long term, so outside of one operating year. Does that help clarify? Yeah, and that's correct. Yeah, one short term, due within 1 year, and the other one is long term. For example, think about your credit card. Think about your credit card payment versus your student loans. You're not making any student loan payments right now, so it would be a long-term liability, but you are making interest payments on your credit card right now, so it would be considered a current liability for you. On the personal side, I mean. So now, if you found that the balance sheet was a little finicky at first, I totally get it. Balance sheets are. We're now going to talk about the income statement, and you'll be relieved to know the income statements are a little bit more straightforward than balance sheets, which is good, because we're really just dealing with costs and sales and profit. However, we are going to show you how to create an income statement that's fairly specific to our industry. It's actually not terribly specific to our industry, but it is the common way to show an income statement. So today we're going to show you different ways to create, that you can create an income statement and what the income statement is. Okay. Then we're going to show you how to use the USAL to create an income statement for food service or the hospitality industry. We're then going to talk about special income statement items, comprehensive income, and ultimately show you what all of these different income statements look like. So the income statement, I believe we had mentioned this earlier on in the course. It is a financial statement that shows financial performance for a particular period of time. Okay, and financial performance is always profit, right, or the amount of profit. Income statements, as a result, include the balances of all our revenue, expenses, accounts, and our net income, which is our revenues minus our expenses. Remember that, I'm just going to put this up on the screen here. Our profit is equal to our sales minus our costs or expenses. Income statements may also include some special items, which we're going to talk a little bit about later. And these special items are costs or sales or revenues that are not typical in nature. So they don't happen often. They're special, if you will. That's why we call them special items. A single step format of an income statement arrives at your net income in one step. Okay, you calculate your profit once on the income statement. So you list your your revenues, You list all your costs and then your profit. It's a very simple income statement with only one calculation of profit. And this is what it looks like. In this particular income statement, we've listed all of our revenues. So we have our total revenue or total sales. We've then listed all of our costs and our total expenses. And we've calculated our net income or our profit only once. Only one time have we taken our sales, minus our costs, and arrived at our profit. So if you take 108,000, you subtract 90,000, you will get 18,000. That is the one step, right? Income statements do look a little bit, actually, okay, up there. On the other hand, we have a multiple step or a multi-step format income statement that arrives at net income in three to four steps, depending on if there's special items. It provides a lot more useful information to all users of accounting information. Okay, and in some cases, it says managerial here, but the multi-step format income statement provides useful information to all users. And the USAL is one example of a multi-step income statement. USAL stands for Universal System of Accounts for the Lodging Industry. And it arrives at net income in multiple steps, or at least three or more, I'll say. I have an example on the next screen. There we go. So this would be a multiple step income statement. Up here we have our sales, right? We have our cost of goods sold, which is the combination, in our industry, is the combination of our food and our beverage cost. And then we calculate a running profit number called gross profit. Gross profit is the amount of profit you have left over after you've covered your cost of goods sold. And it is the first time that you are calculating income on the multi-step income statement. We then also break up our costs into different categories. So the next category on the income statement is our operating expenses. Excuse me. And our operating expenses are expenses that are characterized by being incurred or generated for the overall use of for the business, right? And cannot be allocated directly to our sales line. I'll go over that a bit more in a second. So we list all of our operating expenses like that. We total them all up to get our total operating expenses. And then we come and calculate our second income number, which is called our operating income. Your operating income is equal to your gross profit, subtracting your total operating expenses, and you get your second running profit number right here, or 12,000, which is your operating income. Your operating income is the amount of income you have left over after your sales have covered your after your sales have covered your cost of goods sold, all of your operating expenses. So in this case, we've got 12 grand left over. This is good, right? Next, we have non-operating costs. Okay, so this is any other costs. These are usually fixed or special items. In this case, it looks like a whole bunch of special items and no fixed costs. Typically, this section is called fixed charges, but we'll show you that in a second, where we've listed all of our non-operating costs to calculate our total non-operating costs. And then we can finally arrive at our last income number, which is net income, where we take our operating income, subtract our total non-operating costs, and it will give us our income, net income. So we've calculated, I'm just going to erase this here. We've calculated income once here with gross profit. We've calculated it twice here with operating income. And we've calculated profit or income a third time with our net income. So this is what we would consider to be a multi-step income statement. And we break up our costs between costs of selling departments or distributed costs, our operating expenses, which are costs that are undistributed, and then usually our fixed costs. We'll go into a bit more of a definition around these items in a second. But before I do, does anybody have any questions I can help answer before we continue? No? Okay. Or if you do, throw it in the chat. So getting more into detail about the multi-step income statement and the USAL income statement, we break up our income statement into 3 different sections. And after each one of those sections, we have a profit number that we calculate, right? Section number 1 is our operated departments. So these are sales and costs that can be directly allocated towards or matched towards each other. For example, food sales and food costs can be directly allocated toward together. Same with food, beverage cost and beverage sales, right? And usually this is usually it goes the list or the format goes your sales, total sales, your cost of goods sold, and then your gross profit. That is your section number 1. Okay. Section number 2 is for your undistributed operating expenses. So these are costs that you list that are incurred for the overall use of the organization. For example, total labor, right? Our total labor in our industry, we'll say, for example, for a restaurant, we have front of house labor, we have back of house labor, we've got back of house management, we've got front of house management. Can we directly match those or that total labor to either your food or your beverage cost? I'm going to answer this one, but the answer is no, because think, for example, a dishwasher. Is the dishwasher alone solely responsible for the cost of that dishwasher solely responsible for creating those sales? No, right? Or for example, would be another example, your utilities, right? Your utilities cannot be distributed to your cost of goods sold because those utilities were used so the business in general could run, right? It was not responsible, or that cost was not responsible alone for creating your sales. On the other hand, your food and your beverage costs were. Yeah, absolutely. And maybe let me just double check. I'm going to go ahead a couple slides because maybe this is best given by an example. So your section number 1, which is your operating costs, your operated departments, is where you list your revenues and the expenses that were allocated to the revenues themselves. So for example, in this, let's say you have your food sales. What cost can be directly allocated to or be responsible for producing your food sales would be your food cost. The same can be said for your your beverage sales and your beverage costs. Those are your food cost and your beverage cost are the only costs that will ever show up in your section 1. In food service, there's only 2 costs. And these make up what we call your costs of goods sold. And your cost of goods sold can be directly allocated or matched to your food and your beverage sales. Think back to the matching principle. Does that help a bit, Mary Ellen? Let me see if I can do. I'm just trying to see if I've got at what slide I have an illustration. Not quite just yet. So we have another line on the income statement for, we have a line for our sales. We list all of our sales. And then the next is our cost, our COGS, or our cost of goods sold, yes, where you list your food and your beverage. And then your gross profit, and that makes your section 1. Absolutely. And then the next section, or the second section, is where we list all of our undistributed operating expenses. And yes, you would combine your food and your beverage sales for your total sales, absolutely. And your undistributed operating expenses are incurred for the benefit of the overall organization, right? For example, your labor is incurred for the overall use of the business. Any utilities, so electricity, water, gas, all of those are incurred for the overall use of the business, right? And things like that, okay? And those cannot be matched to your food or your beverage sales. I mean, you needed to incur those costs to produce sales, but you can't match them or allocate them directly to your cost of goods sold because they weren't. You could have had 0 sales and still had those costs, right? And then the last section is reserved for fixed costs. So these are not really under the control of management. They're fixed. So yeah, they're your fixed costs. So they don't change with any sales level. And some examples would be your rent, fixed interest, depreciation, and maybe some property taxes. So I'm just going to go back here. Here we go. So this right here, your sales and your cost of goods sold, this is your section 1. Okay? Because your cost of goods sold is just that, the cost of the products that you sold to customers that produced your sales, so they can be directly matched or allocated to those sales or distributed to those sales. Next, here are your operating expenses. This is your section 2. There we go. And then the last one is it's supposed to be your fixed charges, but it's, in this case, it's not. It's your section 3, which is your fixed costs. Okay. How does everyone feel about that? I mean, I'm going to do an example, but at this point, how are you feeling about it? Okay. We've got the time, so I'm going to throw up a poll here. Bring up a question here. What do you think? Your food and your beverage costs would show up in which of the following sections on an income statement? Section 1, Section 3, or Section 2? It could be another 30 seconds. All right, yeah, most of you got it right. Your food and your beverage cost would show up in Section 1 because your food and your beverage cost have your cost of goods sold. And your cost of goods sold can be directly distributed or allocated to having produced your sales. Okay, so I'm just going to do another one here. Polling, multiple choice. Your think about this one. So your rent expense or your rent cost would show up in which of the following sections on an income statement? Section 1, Section 3, Section 2. Here you want to ask yourself whether or not your rent is a fixed cost. Okay, maybe another 30 seconds here. In the order. All right, I can tell there was maybe a little bit of confusion here. The answer here is Section 3. Your Section 3 is reserved for your fixed charges or your fixed expenses. Rent would be an example of a fixed expense or a fixed cost, right? Whereas Section 2 is for your undistributed operating expenses. Could you make an argument that rent is an undistributed expense, which is classified or defined as an expense that is incurred for the overall use of the organization? Yes, you probably could make a good argument there. However, it's still a fixed cost, and fixed costs go in the third section. All costs that are not fixed and not in your cost of goods sold go in Section 2, which is your operating your operating costs. So good. There we go. So let's go forward. And then here's those differences again. Again, 1 is the operated departments, Section 2 is the undistributed operating expenses, and Section 3 is your fixed charges. I'm just going to go to our... So special income statement items. So sometimes there are things that happen in business that they happen, but they don't happen very often, okay? So these special items are all, while you can have different special items, they're all characterized by not occurring frequently, okay? In fact, they don't reoccur often. Extraordinary items are those gains and losses, so revenues or costs, of an unusual and reoccurring nature, right? For example, losing a lawsuit would have you pay damages. That is a loss that is unusual and non-reoccurring. So that would be considered an extraordinary item. What would be a gain? Maybe a gain would be the appreciation on a piece of land that the company owns. Okay, that is unusual and non-reoccurring. So that would be an extraordinary item. Discontinued operations, on the other hand, are gains and losses from the disposal of a business. So if you sold a business and you got more money than the business was worth, that's called a gain. Okay, or if it was you lost money on the deal, or you sold it for less than it's worth, it's a loss, right? And then the last special income statement item could be the cumulative effect of a change in accounting principle or technique, right? Remember back to the beginning of the semester, we talked about consistency, or the consistency principle, in that we have to treat similar events in a similar way. So for example, depreciation. If we start calculating depreciation on an asset using the straight line method, we have to continue to do that into the future. We have to be consistent. That said, you can change your practice or your accounting practices. However, you need to go back and change all of your prior accounting or financial statements. This would create a cumulative effect in of a change in your accounting principle. So it doesn't happen very often. And all of these things, I'm just going to go back here. All of these either gains or losses or special income statement items create what we call comprehensive income. So that's adding these gains or losses from either extraordinary items, discontinued operations, or cumulative effect of a change in accounting principles to our net income for that particular period. So it's just adding that gain or loss to the net income for the period. And just like the income statement, we can do this in one of two ways. We can do it in the one statement approach or the two statement approach. And just like they sound, you can show comprehensive on one overall statement. On the other hand, you can show it in two separate statements. And I have illustrations of both. So here we have a multi-step income statement, or comprehensive income statement. We have our sales, our cost of goods sold, our gross profit, our operating expenses, and our net income. And then we have a special item, which is an unrealized holding gain. Okay, so that's a gain on land or something like that, where we take our net income, we add the special item because it was a gain, and it will give us our comprehensive income. What this means is that this $140,000 is income comprehensive of special items. In this case, the special item was an unrealized holding gain. Okay, and we've done this comprehensive income statement in one statement. Okay, there's just one. On the other hand, you can separate that into two statements. One where you have an income statement, and then you have another statement called a comprehensive income statement, where you take the net income from the prior statement, the prior income statement. You then, like the other, you add the special item. In this case, it was a holding gain, and you get your comprehensive income. Exact same numbers, just the only difference between the two is this is done in two statements, and in the other way, it's done in one statement. And in this example, it was a gain, so we add it to our net income. If we had a loss, we would subtract it from our net income, and our comprehensive income would go down. So now what we're going to do, don't worry about this point right here. Your worksheet is due by the end of the week. Why is there a single and multiple statement approach? That is a fantastic question because human beings like to complicate everything. What would I say here? Well, if I had a loss, if I had a special item that resulted in a rather large loss that affected my comprehensive income, obviously because it's a loss, I would personally want to show my financial statements or my comprehensive income statement into two separate statements so I could show that my net income for the period was good or really good, but because on the second statement my comprehensive income was a lot lower than that because of the loss, right? So it could be a matter of presentation. It could be also a matter of preference as well. It's a good question. So now what I'm going to do is I'm going to share my screen again, and I'm going to create an income statement on the worksheet. Okay, and I'm going to do it in a very similar manner. I'm going to go through the what is it called? The sections. And how do we calculate comprehensive income? Your comprehensive, it's always your net income. Okay, plus or minus gains or losses. You add a gain and you subtract a loss, and that gives you your comprehensive income. And those gains or losses stem from those special items. Absolutely. No problem at all. So I'm going to share my screen again here. There we go. So we've done the balance sheet, and here we have a blank income statement. Unlike the balance sheet, I have not included any of the sections. Okay, so first here I'm going to include some information. I want to give some titles, so this will be Dave's. We have to name the company first, so Dave's company. This is an income statement. And the time period for the So here I've given my name or the company name, followed by the name of the statement, which is the income statement, and then the time period that this income statement covers. So in this case, it's for the year ending December 31st, 2020. Okay. So the very first line on any income statement is your sales, right? So I give the heading, or sorry, the category a title. And now I want to go to my financial worksheet and figure out what kind of sales I had. So I'm going to look through this here. Sales typically have a credit balance. Oh, and they're on the income statement. Sorry. When you're doing this, look at the income statement portion here. Okay. So I had some food sales of 13,000. Okay, so I'm going to put that in here. There we go. 13,000. 1, 2, 3. There we go. Go back and see if I had any more sales. Oh, that looks like my only sales line. So I only had food sales. So I'm going to go back to my income statement, and that's done. So total sales is 13,000. Yeah. I can now put in my first section of costs, which is my cost of goods sold. There we go. And pretty typically, I can assume that if I had a food sales, I've got a cost of food sold. So I'm going to go through here, try and find my cost of food sold. Yahtzee. So I had a cost of food sold account with a balance of 500. So I'm going to go back to my income statement. I'm going to put a cost of food sold. And then it was 500. I'm just going to double check that that's my only cost of goods sold. Yes. Okay. Yeah, it was. So I'm just going to total it up. There we go. $500. That's it. Now we've come to our first running profit number on our multi-step income statement, and that is our gross profit. There we go. And our gross profit is the amount of money we have left over after we've covered our after we've covered our cost of goods sold. So what I do here is I take my total sales and I subtract my total cost of goods sold, just like that. In this case, I get 12,500. Okay, so I'm going to stop sharing my screen and see if you have any questions. Vanessa, what about cost of beverage sold? Was there a cost of beverage sold account on there? Did I miss that? No, there was no cost of liquor sold. We also didn't have any liquor sales. 350 beverage sales? I'm not seeing any beverage sales. Oh, okay. If there is any or none, we don't put it. Yeah, so if you do have beverage sales, then you would include it. If you don't or didn't, then you don't. If you had beverage sales, then you automatically have a cost of beverage sold. And if you didn't have any beverage sales, you might still have cost of beverage sold, but it's unlikely that you would. So in this case, we just don't have any. Yeah. Absolutely. All right. So I will continue with our section number 2, which is for operating expenses. Application screen. There we go. So I'm going to go back to my income statement. I'm going to come down here and I'm going to put a new section. So operating expenses. Go. And go to financial worksheet and look for some operating expenses. Our utilities expense, that is definitely an operating expense because it is generated for the overall use of the organization and it is not fixed. Go. And it was $1,000. There we go. Back to our financial worksheet. Let's work down the income statement side. We have a rent expense, which is a fixed cost, so that goes in section 3, not section 2. We have a wage expense, which is variable, so not fixed, and it's incurred for the overall use of the organization. So it would be in our section number 2 for $3,240. So I'm going to go to my income statement, wage expense, and I forget how much it was, so I'm just going to pull it over. 3,240. I think that's the right line. There we go. There we go. Excuse me. So we come back to our financial worksheet. The next one down is our supplies expense. That is variable, and it is undistributed. So because we buy those supplies for the overall use of the organization. So I'm going to put that in my section number 2. So my supplies expense, $1,500. Go. Back to my worksheet. Keep going down. We had a depreciation expense for $350. That is technically a fixed cost, so we're going to leave that one. And then cost of food sold, we've already done that. Sales, I've done that as well. And then we had an interest expense, which is typically fixed. Okay, so I think we got all of our operating expenses. So I'm going to go to my income statement and type in total operating expenses. There we go. I'm going to total it all up. For a total of $5,740. Now I've come to my second profit number, the second step calculating our income, which is my operating income. Calculate that. I take my gross profit and I subtract my total operating expenses. That, in this case, I get an operating income of $6,760. So I'm going to stop sharing my screen and see if you have any questions. Wage expense. Did I put in the wrong amount? Let me just check. Wage expense was 3240. 3240. Yeah, that's the right one. 3240. Not a problem at all. Your operating income is your gross profit. So I'm going to type it in the chat here. Operating income is equal to your gross profit minus your total operating costs. There we go. So just in the chat if anyone wanted to see. Not a problem, Nick? No problem. All right, so I'm going to share my screen again, and then we're going to go through section 2, which is our fixed charges. Go. Okay, so I'm going to put in my, what did I just do? There we go. My next section, which is fixed costs or fixed charges. I'm going to go look for some fixed costs on my financial worksheet. So my utilities was in the prior section. Rent expense is definitely a fixed cost for $5,000. So I'm going to put in rent expense. There we go, 5,000. There we go. Back to my worksheet. We've put in the wages, the depreciation for 350. Depreciation, in this case, we'll assume that it's calculated on a straight line basis, so it is a fixed cost. So put that in here. Depreciation expense. Oh, I believe it was $350. Perfect. Let's go back to our financial worksheet. Depreciation expense, that was good. Cost of food sold, that was in section 1. Sales, also in section 1. Interest expense, which I believe, which is typically fixed. I'm just trying to make sure I've got all the other ones as well. Yeah, okay. So our interest expense on loans, I'm going to put that in here. There we go. And it was $83. And that was all of the information on our worksheet, or our financial worksheet, so I can start to finish it up now. So our total fixed costs is equal to the sum of the above items. There we go. We have total fixed costs of $5,433. Now we can calculate our net income, which is our last step in calculating, or last time calculating income, where we take our operating income and we subtract our total fixed costs. Excuse me. So our net income is our operating income subtracting our total fixed costs. So if I do that, I get $1,327. All right, so $1,000 in profit, and I just want to go to my financial worksheet to make sure that is the same. Yeah, I got the same profit number, which is good, which means we did it correctly. So we have our first section right here, so operated departments. We've got our section number 2, which is undistributed costs. And then we have our fixed costs, which is our section 3, and our final time calculating profit. So here's our income statement. Yeah, looks pretty good to me. If you wanted to, actually we won't go there just yet. Don't want to do too much in one day. So I'm going to stop sharing and see if you have any questions. All right. Does anybody have any questions I can help answer? How do you feel about that? Good, bad? Easier than the balance sheet? Harder than the balance sheet? Ryan, yep. Section 3 is all fixed costs. Section 2, yeah, variable. Yep. But they're variable undistributed costs, because technically your food cost is your section number 1 is your cost of goods sold or your operated departments, and those are variable costs as well, but they are directly allocated or can be directly allocated to the sales that they produced. So food cost, food sales, beverage cost, beverage sales, things like that. Yes. Ooh, dropping stuff. All right. Put a thumbs up in the chat if that was fairly if that felt good. What do you think? Wait for some more thumbs. Vanessa, section 1 is, they call it operated departments. Yeah, exactly, but it's sales and cost of goods sold. Yeah, I think that's easier to remember. It's your sales and your cost of goods sold. Oh yeah, no, well, it is included in the section. Yeah, is your gross profit. No problem. All right. Oh, my eyeball. All right. Well, that was really good, and I'm happy we were able to catch up a little bit and kind of slow it down. That's all the. I don't want to get too far ahead with next class's content, because it is a little bit different, and we do return to the accounting process again. So we are going to be talking about debits and credits next class. We're going to be talking about closing entries, and I had already kind of mentioned before, but closing entries is where we close revenue and expense accounts to prepare them for the upcoming accounting period. Okay, there is kind of quite a bit of few moving parts to it, but as long as we kind of have the not really, if we have the logic as to why we do it, then it should be fairly good to go. Okay, so we'll leave it there for today. Okay, maybe use the rest of class time to complete the worksheet that's due, and we'll have these worksheets due by the end of the week. Or yeah, that's it. Sound good, everybody? Awesome. No, thank you guys. It was a great class. So we'll conclude there. Everyone have a good rest of your day, and we'll see everybody at 1 o'clock on Thursday for closing entries. Have a great day, everybody.